2025 markets and musings, really. Just some thoughts for what I'm seeing for the year ahead. And just a quick disclaimer, as ever, we're sitting here in England. I'm sitting here in England, people from all over the world. This is very much educational. It is totally educational. There's no investment advice given here whatsoever. So there's the disclaimer. And as long as you're all familiar with that, let's crack on. So in this presentation, I'm going to talk for about 30 minutes, 40 minutes, and we can do some questions at the end. I'm going to look at the market overview where I see it right now. And basically, we'll look at some ideas there on how to, of what's going on. And then I'm going to show you what markets I'm looking at. And we might see some repetition of what you've already seen. So don't worry about that. So also we'll take some Q&A at the end. So let's start off the market. So years ending in 5. Here is the decennial pattern for the stock market. In this case, we've run it back to 1900. So there's 125 years of data here, or 12 full decennial cycles. And what do we see? Well, the years ending in 5 tend to be the most bullish years of the decade. So what did we see last year as well? A bullish year. And in fact, when we entered last year at the end of 2023, a lot of the sentiment was very bearish. And we did forecast this bullish year there as well for those of you who saw that. So that's the first point to make. Years ending in 5 are bullish. It's also, for those of you who study the work of people like Gann, he called it the year of ascension. And if we take the last 80 years of data here, you can see a few things here. First of all, this thick blue line here, and let me put a pointer up if I can somehow. Let's put a laser pointer. Right, there we go. So this blue line here is the average of these 80 years. You can very clearly see the year closes a lot higher than it begins. The only other thing is, take a look at this. When we get to August and all the way through into, when we get to October, all the cycles, all of these 8 cycles point up. So that's something you might want to think about. That is obviously 10 months away, but that one there, the odds are 100% bullish as we get to the month of October. So something to think about there. So next up, let me just, here we go. I just want to highlight a few dates here, just on this. So this is, as I say, this is the composite of those 10 year, of those 8 cycles there. And what we see here is a low round about the 20th of January. Well, we did get a big update today on the S&P. If we hadn't got that, I'd be looking for something really round about the 20th of January. Averaging these cycles, the 3rd of March comes out, bear that in mind, and also the 25th of March there. And then a run up here to the 15th of July, and then the 24th of August. And that then effectively becomes the low for this modeling. 24th of August is always an interesting day in the markets as well. The 1987 top actually came back in on the 24th of August. So that's just some information. It's just FYI. Bear that in mind. Remember, certainly those of you who know my work, and I see many familiar names here, you know then that we're all about getting the odds on our side. It's all about incremental gains, and there is no real holy grail in trading and investing. So just bear those in mind. Next up, we see this. Now, this is something different. Now, let's go back to the bigger picture here. I'm going to come to these histograms in a minute, but the first thing to note is that we are 15 years in this bull market from 2009, 15 years, or albeit with this pandemic pullback here and another pullback here. Sorry, that was a pandemic pullback and this other pullback here. So 15 years, what's that tell us? Well, basically, if you're kind of newish to the markets, i.e., if you hadn't been trading and you're maybe around the age of 35, you've probably never seen a proper bear market. Now, that's quite astounding. Now, let's face it, who are sitting at the desks at the major institutions. A lot of people in their 20s and 30s have got the energy to do the long 18-hour days and so on. They probably have not seen a serious bear market. So that's something to think about. And those of you who understand cycles know that the 30-year cycle is a very strong cycle, 15 years representing half of it. We're also 30 years from the 1995 breakout. I'll show you that picture in a moment. What I want to do is, though, talk to you about these histograms, which is a huge summation of a ton of cycles. And what we're seeing here is this. It's a very sharp peak here on a monthly chart that actually goes back all the way to the 1950s and further. But what you can see is where we see these peaks, they tend to suggest a major turning point is coming in. They don't always work, but for the most part they do. And you can see they align quite often with potential changes in trend. We're certainly seeing a change in trend now, and we're in a 4-week pullback, 5-week pullback now. Where that's upon us. And the key point about this is that they're predictive, so they're known in advance. And this one has been flagging for several years. So whilst years ending in 5 are bullish, I think we might be about to see a pullback. Well, we have been seeing a pullback for the last 5 weeks. The question is how much of a pullback. So let's just go a little bit further and see what else we can see. And here's the visual representation here. So this is the 2009. This is the global financial crisis. That's the 15-year cycle. And here's the 30-year cycle from what I consider to be one of the biggest breakouts there. And that there is shown, this was a sideways range back in 94 to 95 from which we broke out very clearly. And whilst in this case, the Dow was in this sort of box pattern, trading range pattern, things like the FTSE were making a sharp triangle, the British index. And this was a very significant point here from which we really see, I wouldn't say the genesis of the present bull market, because that really starts in 1974. But this is where the market heads up. So a couple of interesting points here. These are very important points. 30 years from a major inflection point, 15 years there as well. Okay, so with that in mind, years ending in 5. However, as I like to say, prepare for something different. We've also reached some major price targets. So I think we are probably going to see a bullish year. I'd certainly agree with Jake on that. We might see something before that. Are we going to see a sell-off before the rally? Is that what's going on now? Are we likely to go much higher? Well, I do think we're at a major price target as well, both on the Dow and the S&P 500. But that doesn't mean we're not going higher. It just means we might be pausing, heading sideways or heading down. With that in mind, there is 1 year ending in 5, which basically was bearish for most of the year and then closes flat, pretty much flat. So there's the end of the year right there, and there's the beginning of the year there. So what we can see here is we got a pattern. We got a bit of a sell-off there and look at that date there, August the 24th. Interesting. I'll come back to that in a minute. Then we got a strong rally. So are we seeing something like this where this market sold off into the 30th of January? So I think this is going to give us the clue as to what's going to happen. If we see a sell-off into the 30th of January, or maybe even the 20th, if we see a sustained sell-off, yeah, I know we saw a strong move up today. That could give us some clues. So as I say, the key point was this market was pretty much flat, having spent most of the year underwater. The beginning of the year, beginning of 6, though, saw quite a sharp sell-off there. Just the other thing here, I'm just going to remind you of these points here. 3rd of March and 25th of March. This is the average of the 8 cycles and the 24th of August there. So interestingly enough, there's the 2nd of March showing a high, the 25th of March showing a low, and there's the 24th of August showing a low. So interesting stuff. It's just FYI. So if we get a pattern match, you might want to bear these things in mind. So those are the thoughts so far. So the strategy is really, it's all about timing the market. It's more important than ever. I was just talking to our dear friend and fellow board member, Bill Sarubi, this afternoon. You'll be seeing Bill tomorrow. And he said, market timing is more important than ever, and I had to agree with him. Understand chart patterns, know how to read them. That is really one of the most important things, and use all the tools. And with that in mind, what do we see? Well, what are the key? So using seasonality. Seasonality is all about getting the odds on your side, the highest probabilities. One of the highest probability setups in seasonality in our work, in our platform, that gives us quite a bit. We've put some AI into this now. One of the sharpest moves up that we see, the highest probability moves, which are optimized for certain time periods, begins on the 28th of January. Okay, and then basically ends on the 14th of February here. So what does this mean? Well, historically, over the last 45 years, if you'd gone long, regardless of any risk management and so on those dates, on the 28th, and then you sold out on the 14th, 85% of the time over the last 45 years, you'd have made returns averaging 33%. So that's pretty good odds. Now, that's a seasonal trade, but how do we use this with the conundrum we're in right now? Well, the answer to that is, if this market starts turning up, we've got one date of the 20th and we've got another of the 30th of January from the bits and pieces that I've shown you, using previous cycles and modeling. But if we don't see any sign of a bull market at the end of January and the beginning of February, we know we're in a much weaker market, especially if this market does continue to head down and not take out the high that we saw at the beginning of December. So this is quite an important thing. This is a very important point to note. These are the clues. So Jake talked about seasonality. We all do seasonality. We all do it slightly differently. Seasonality, when it fails, gives us a lot of clues. And of course, at the first level, seasonality is the way to make good money. Just, if you take all the seasonal trades all of the time, you will make good positive returns. So that's where we're at with that. Next up, looking at the smart money. Well, the smart money is the commitment of traders' data. So again, Jake gave you a very good insight into that. And myself, we found that the Dow futures is the best indicator for hedging. And as we know, the commercials are the smart money. They are basically hedging. And what we look at here is we've got an index. And when it gets to an extreme, when it's up here at the top, we're looking for a buy situation. And then when it gets down, things cool off. And when we get to a zero, we're at a sell situation. But you have to look at the other factors. Well, what are we seeing here on the Dow minis is really the commercials. They're not really buying a huge amount, and they're not really selling, and that they are less bullish now. They are less bullish now than they were in December. So that's not sustaining an immediate move up. They've reduced positions on both sides. Now, the non-commercials, which is the hedge funds, they are in an interesting situation. They have basically they've been leaving. They're not buying as much. They're not as bullish, and the selling has stayed constant. And the net bullish situation is heading back towards a zero situation. So it's, to me, I do think in the shorter term, as I say, we've got these super big time cycles that I showed you there. Using the histograms, we've got a 15-year pattern and a 30-year pattern, and there isn't a huge amount of buying power showing just yet. So let's look for some more clues. Let's see what else we can see. Right, so this is something else that's quite interesting. The non-reportables. So the non-reportables are the small traders. And basically, the interesting thing about small traders is they tend to be the wrong way at extremes. And in fact, a lot of the time. And what did we see? We saw the highest level of small traders buying here right at this peak. And not the last time, we got some interesting stuff here, which basically flatlined, i.e. they were buying and the market wasn't heading anywhere. But look at what happened here, around about here as well. A huge mass at this level. And very specifically with our work, we take the specific numbers off different levels of positions, and that enables us to identify extreme highs and lows. So we're Jake, myself, a lot of us use commitment of traders data, but we use it differently. And you'll see this unfold over the balance of this presentation, and how we've derived either similar or contrary opinions. You can decide at the end. But the key point is the non-reportables, who is Joe Public, a lot of day traders, etc., got to a very high level of buying just at the top because they are usually wrong at these points in time. So we're still looking for data. There's nothing really saying that we're going to go racing up at the moment to me, and there's nothing saying we're going to crash. So let's take a look over at the next chart, and this is the VIX, the volatility index. Again, let's see what's going on. Well, basically, the commercials, and they're the smart people, they tend to know when something's happening. You know, look at the amount they hedged just as we got up to this spike here, okay, in the VIX. They were well in there hedging. So, and they're at very low levels of buying and also selling. I mean, they've just ticked up a weeny bit now, but not a huge amount. But they're down at low levels. It's not like they're ready for some sort of Armageddon situation. Equally, the non-commercials, the hedge fund trend followers, they've reduced the selling, they've reduced the buying. So basically, this is insurance. They're not buying insurance. So these people are not particularly looking for a crash, and neither are these guys, really. There's no real hedging going on. So we've got a big cycle in. Are we going to flatten out? That's one scenario. Are we going to head sideways for a while? Or are we just going to pause for have this pullback and then go shooting off to new highs? So basically, the other thing that geopolitical event that commitment of traders data will miss is a geopolitical event, and that's of course what we specialize in with our geopolitical forecasting. So yes, we are open to some sort of geopolitical event window. So that's where we are with this. So summing it up, we've got a 15-year bull market in place, pretty much. We've got 30 years since a major breakout in 1995, and you know that looked tiny. It looked minuscule on that chart. I can assure you, I was looking at and trading at these points, and that was a huge breakout. I remember, actually, I can very specifically remember sitting in a cafe in Nice with a colleague in the summer of 1995 saying this market is about to break out. And that was 30 years ago. And who'd have thought we are where we are right now? To say we're hitting some major price targets, but there is no real concern showing from the commitment of traders data. So what are we getting? We're going to get Trumponomics 2.0. I think he's going to invest very heavily and basically look at bringing the American economy up, and that will be bullish for the stock market. So that would be a scenario that sees us going a lot higher. We might see a flash event. I think that is really important. So what are we going to do? As I say, the first clues are the chart pattern. The next clues are, let's just see if this seasonality that comes in at the end of the month works or fails. That could be quite good. And let's look for changes in smart money and chart patterns. So those are the ways. The truth is, I am potentially, I think we've reached an important target, and I'm looking for a little bit more of a pullback. That's personally what I think, but the markets will tell us. So that's the first part. Next up, I'm just calling this musings. So these are just some thoughts to run past you and bring a little bit of a few other bits and pieces relating to cycles. And I want to just show you this. Now, most of you will be familiar with this. There's various versions of this chart floating around the internet, and they've been updated by various people. I've had this on my wall just right over there. You can't see what's on the wall here. Ron and so on have been around here. And there's some interesting things. It was created by Samuel Benner back in 1875. He was a farmer, and he was concerned about the price of crops, or whether he could forecast these and so on. Basically, he looked at pig iron prices, And what he found that lows came in every 11, 9, and 7 years. And you can see how these are. So you've got 7, 11, 9, 7, 11, 9, 7, 11, 9, etc. there. And highs came in there 8, 9, 10 years, 8, 9, 10 years, etc. And he overlapped these. And as they say here, by Jove, it doesn't half work well. It's pretty good. And where are we now? Okay, so well, did this work? We certainly got a big move there, didn't we? Into 2019, we got a massive move into the year 2000, the end of the last uh, millennium and century, and that was the dot-com boom there. I think you'd have done all right if you got into the stocks there in 1996. Remember what happened in 1996? I just showed you that, right? The 95, the breakout. So that would have certainly worked there. So that has worked. And by the way, the last 5 years of the last 3 centuries have seen extreme bull markets. So this was the dot-com boom. We did come down to 2003, really, and so on. Then what happened in 2007? Global financial crisis. That kind of, we recovered from that in terms of the stock market in 2009, and then it really got going by then. 2019, very end of 2019, pandemic, first signs of it in November, December, and of course by the third week of January, panic was setting in, and the mid of February saw a crash. So, you were talking about 6 weeks into the cycle, into the next year, and we saw that come down. So the key point is that we're in an upcycle into 2026. So just bear that in mind. The bigger picture is quite bullish indeed. So that is just something I wanted to point out to you. So I think that's a useful chart, and I wanted to share it. I'm not sure if we've looked at it here before. Next up is this. Oh, yes. So, yeah, other musings on this. It effectively replicates the 18.6-year cycle, which I know many of you will be familiar with. As you know, I use it as a generational cycle. A book called Stock Market Forecasting was written by a lady called Louise McWhirter, and that really highlighted the efficacy of this cycle. And more recently, our dear friends Phil Anderson and Akhil Patel have expanded on this work. And I was talking to Akhil this morning with his permission. He has kindly sent this. And what this is the 18.6-year real economic cycle and real estate cycle. So not necessarily the stock market cycle, but the real estate cycle. And the 18.6-year cycle is the main governing cycle of the economy, especially in the United States. Now, it does also tie up with the United Kingdom, and it has driven the main boom and bust period since at least 1800. And basically, you can read all about this. Phil Anderson's book, The Secret Life of Real Estate and Banking. I'm shamelessly plugging it for him. He is a very decent, solid man, as too is Akhil Patel, who's provided this. And he has released The Secret Wealth Advantage, which is telling you how to operate this cycle in great depth. And we'll come back to Akhil in a minute. But at the end of each of these 18.6-year cycles, there is a major financial and banking crisis and a major economic recession or depression. Therefore, knowing where you are in the cycle is key to investing and trading with clarity and safety. And the cycle is structured as follows. So it's an 18.6-year cycle, but it is basically 14 years up, 7 years up, a little bit of a pullback there. Okay, and did we see that? Yes, we did see that. We saw a pandemic pullback. Then we got another 7 years, taking us to 2026. Now, what happens in this interim period? Well, huge infrastructure spending since the pandemic. I think that's definitely happened. Looser monetary and fiscal policy, for sure. Commodities boom in places, and it's still to get going. And the commodities boom, I think, is going to mirror the grain cycles, are going to mirror what happened in the 1930s, where we got the Dust Bowl. So people who follow my work know about that, and why I'm thinking that will be the reason for a commodities boom, especially in the grains. Although if we get tariffs coming in under the new I'll say regime, and then that could impact the US prices, because the net winners of the last grain tariffs were actually South America, not America. They production and sales switched to there. Anyway, then we get to this point of very easy money. Okay, stock market booming, new highs. Well, we had a new high only 5 weeks ago. Everybody's day trading. Have you seen the number of day traders that are out there? When we see that happening, we know, and 0 day option expiry and all that sort of stuff. These are signs of very easy money, and that also heralds the end quite often, or pretty close to the end of a bigger move up. World's tallest buildings announced. This is a good one. We saw something. So what did we see after the 1929 crash? What did we see? The roaring 20s. What we saw there was some of the largest buildings went up in New York, and the Empire State, well, the Chrysler Building and the Empire State Building. The Empire State Building, I think, opened in 1932. So that was 3 years after that. I could be corrected on it, but I know it was well after the top on the stock market. But the construction of these buildings began as the markets were booming all the way up into 1929. So 2026. Okay, so this is really important. Basically, what's happening here is we're potentially approaching, both in America and Britain, a real estate top within another year. Okay, but remember, when these things come in, liquidity dries up. So be aware. I know I've got friends in America that have been talking to about selling property. Be aware, if you're listening in, this is an important top and we're not far from it. And this is a phrase that comes out. Remember the thing that this time is different, when all the commentators, your CNBCs and your Kramers and all everybody say this time it's different. So this is where it's been reported time and time again this cycle. CEO of major real estate or real estate developers, real estate prices will never go down again. Well, they do. They go down absolutely perfectly in this 18.6 year cycle. And of course, the very tall buildings open with no tenants. And that's exactly what happened to the Empire State Building in 1932. I'm sure it's 32. So basically, in these phases, we've got the first expansion, we've got a slowdown, we've got the second expansion, and then we've got this peak here. So what I'm really saying here is that Samuel Benner's work that you saw on that other chart is very similar. It's actually saying something very similar to this 18.6 year cycle that Louise McWhirter first kind of put out there to print. And also that point of the cycle and some of the work I've done right now, this last week or two, is quite critical for several of the commodity markets. There's a specific, very specific point of that cycle. And I don't know if you've been watching the crop reports. I don't know if you've been watching soybeans over the last, over the last 3 trading days. There's been a big move, and that's because the last crop report brought out some interesting surprises. So what we need to note is, first of all, red flag. Now's the time to get your house on the market. Take any reasonable offer, because that liquidity is going to dry up. Potentially, I could be wrong. In America, we might see Donald the Disruptor do something that could change things. I don't know. All I know is that his policies really are going to be quite possibly inflationary and, of course, expansionary. And he's going to put USA first. So, but with regards to property, we are entering the doors, the lobby of the Last Chance Saloon there. And that, I think, is a very important point to make. Before I leave this slide, Akil has agreed. I spoke to him last week. I spoke to him again today. He is going to come to New York to speak. And that is a big honor for us. And his work is absolutely amazing. So be there. Make sure you turn up at the SUNY. Bill Rooney has put up, and the whole team have put so much effort into this already. You must come along. Bill's Irish heritage means we will have to go to the Irish bar around the corner, which I know very well. This is actually on the same street where I stay in New York. I've been staying there for the last 30 years. So I'm very excited about this. So be there. The link will come up. In fact, fellas, if you want to put that link up there, sign up now, because spaces are very limited indeed. I have already taken that whole week off. I can't wait to meet so many of you in person. So with that in mind, Benner's work, the 18.6 year cycle in economics. So what we're saying is economic activity is about to flatten out, really. according to the cycle, but it could be disrupted. It could well be disrupted by the policies of the next president. Right. Other musings, and here what we've got. Well, a lot of this stuff I've mentioned before. The long-term cycles is an 82, that 84-year war cycle, and I briefed you all on this several years ago, and my clients all the way back into the late 20 teens. Basically, if we take 1941, 7th of December, 1941, America is attacked at Pearl Harbor, and the previously neutral United States of America is forced to enter World War II. Previously, it wanted to stay neutral. These wars were seeing a way of potentially the British strength and empire being eroded, and that America was standing by to take that position, which, of course, it did then take this position off the superpower. So this last point here, 1941, we had 84, takes us to 2025. So this is when the war cycles really pick up steam. We've been in a proxy war for the last 3 years. We forewarned you about that. That was as we added the 82 to 1939. So anything from 2021, what have we seen? Well, personally, my followers were given the exact date of the Ukraine invasion. We gave you the date of the Middle East Hamas situation to within 2 days, 10 months in advance. We've seen nothing but global stabilization. It's a proxy war. There are over 40 nations involved in this war. Okay, so the people, nations supplying arms and soldiers to different other nations. And I don't just mean NATO, Britain, the United States, but look at now what's going on in on the Russian side. North Korea is supplying armaments and soldiers as well to Russia. So I think we're going to escalate here. I think this is the geopolitical risk. I think this risk is significant. And basically, Trump, this last few days, has said he wants Greenland and the Panama Canal. And then there's also talks about states being sold to Canada, maybe not, whatever. Right, so what does this mean? Basically, Trump's comments are expansionist, the colonialist, and if you're going to go around at making assertions saying we want this land and that land, well, I just ask you a question? I don't know what the answer is. I have some cycle views on it, but does that not give other nations and other imperialist countries, let's face it, we're all imperialist countries, a green light to go and take what they think is theirs? So I think Trump's language and rhetoric over Greenland and the Panama Canal could well trigger China moving very rapidly into Taiwan. And that, to me, is one of the highest probability black swans. And I think North Korea is going to be part of this global destabilization. I think it's coming quite quickly. I also see an escalation within the Middle East based on cycles. And the 60-year cycle from the Aden crisis is what we're seeing in the Gulf of Aden with the Houthi rebels. And this is where the issues around oil are going to come in. So I'm pretty sure that's what the core issues are there. So just watch out for that. I think the UK, so today I was reading that UK has been supplying missiles to the Ukraine, and Putin and his backers are threatening to launch missiles and strike the UK. So this might seem like rhetoric again, but what if this does happen? You know, remember, they said he'd never go into Ukraine. Everybody I was talking to said that he's not going to go into Ukraine. And remember, you know, if you've followed the work that I've been putting out there, and it's out there on the YouTube channel and so on the Foundation channel and our YouTube channel, basically, if you look at the two sides of the story and take the names and countries out of it, there was a lot of reneging of agreements on the side of the West. So, you know, Putin and the Russian people do feel rightly aggrieved from their philosophy. Remember, I'm always apolitical. I'm just telling a story here. So what if they have had enough and decide to launch missiles? I don't think they're going to launch missiles, but there could be a lot of cyber attacks. So we're talking about an escalation. War cycles are in, and anything can happen. So that's where we're at with that. What are we going to look at? This is what I'm looking at. Now, you might see some overlap. You'll see different reasons, though. Disclaimer, I gave you this at the beginning. I've got to tell you that. This is educational and it is not advice. So you must do your own work. And of course, you will. How do we do things? Well, generally, I'm all about getting the odds on our side. We've got a strong background in aviation that we use for risk management. We bring that into trading and investing. And seasonality is always a good place to start because you've got the odds on your side. Okay. Then look at the smart money, and then we use cycles and geometry. And of course, that's why we're here. We're talking about cycles. So one of the things we do with our advanced seasonality, we look to see what is performing the best over the last 6 and 3 months. And we have a list of those. And then basically there's two things right at the top of the list. Natural gas, okay, which has been performing 100%, and it's the highest probability setups. All of them have worked, as of cocoa. And this is where I'm concurring with Jake. And these are the returns. 4 patterns have worked on natural gas, giving us 64% returns on those. And in cocoa, we've had 2 patterns that have been highlighted, and they've both worked, bringing 27% returns. So the key point is the odds are on your side. And not only that, we also then look at what's correlated. So those are the ones that have actually happened and have worked. And these are the ones here that are correlating the best. That means we can go straight to them. They are following what seasonality is expecting from them. This is what natural gas did, by the way, last year. The 20-year seasonal pattern was this orange one, and the yellow path there is what natural gas did. Okay, there was a deviation there at the end of the year, and that's why you use geometry and risk management. But if you'd followed this, you can see the number of points where lows and highs have come in, and it's been pretty good. That is regular seasonality. So as I mentioned, we're looking at the best correlating markets. Cocoa's coming up. These are the stocks we're looking at, etc. There's a whole host of them here. But let's look at natural gas. So natural gas right now shows a seasonal high here over the last 20 years. And we're just coming up to this point there. And one of our highest probability setups is going from the 27th of January. Sorry, I missed that. January there. Down into the 12th of February. And that's worked 75% of the time in the last 20 years. So in 15 years out of the last 20 years, this has worked, and that has delivered returns of 159% if you annualize, if you add them all together. There it is, 75% returns. And what we want to do then is we want to see this market turn down fairly soon. And once it starts turning down, then we know that this is the strongest acceleration point. And these are optimized for the best results. So 15 wins, 5 losses, and 75% win rate there. And that's, these are the bearish months, and these are the bullish months there for natural gas. As simple as that. So let's look for confirmation. This is seasonality. This is the averages. Doesn't always work. Next up. So what are we looking at? Well, right now, the selling, the index is getting more and more bearish there. And what are we seeing here in terms of the smart money? It's been heading down. The selling is increasing. The buying is steady, and this is heading down towards the net long line towards zero. And what's going on here? Well, not much interest here in the hedge funds either. Slight uptick at the moment, but generally speaking, they've been heading down. So this is looking good to work towards its seasonality. We're going to watch it, and then we look to see how we can manage the risk. Next up, cocoa. So, and Jake and I did not talk about. Jake did discuss. He was going to mention he was going to discuss the grains. So this is my view on cocoa. I'm starting here with seasonality, and what we're seeing here is that one of the next periods is just from about the 28th of February. Of January into there. So if we've seen this come down, we've made a low here. If we carry on up, and that's heading up, then we've got a very good setup here. And that run could be quite strong, especially into the end of April. And just a digression, but something that I was trading a lot of softs back in the mid-2000s, and we did very well with that. And one of the things I discovered there was cocoa has one of the strongest 18.6-year cycles within it. And of course, the foundation does have this long-term data. And so this was something I was using back then when under its old guise. And within cocoa, just as it was then, it's not something I trade very much now, but as this notion that most of the cocoa, the biggest producer of cocoa then was the Ivory Coast, Côte d'Ivoire, in Africa, in West Africa. And the supply of cocoa was really politically controlled. And there were a lot of coups, and these coups seemed to come in every 9 years. So that was two lots of 9 years is 18 years. So that seemed to work there. So that's geopolitics aligning with cycles. And which comes first, the chicken or the egg? So I don't know, but there we go. It works. That's why we look at cycles. So next up, the dollar. So it's been very strong. And in fact, it is the strong dollar that I think is depressing the price of commodities. And we had a very strong weekly cycle this last week. And what have we seen? Well, it's been very strong, and suddenly it's been coming off the bullish index down here. And suddenly, the selling is starting to go up there. And we've gone net short. And what are we seeing here also with the hedge funds? Basically, we're seeing that they're getting more and more long. So I think we're due a pullback, and then I think most likely up. I'm actually a little bit more bullish on the dollar than Jake is, and I think we could easily get up to this double top here in due course, albeit with a pullback first. So how do we look at this? Well, bringing, in this case, we're looking now at the seasonality for the dollar. It's been up. Basically, are we going to pull back here into the very end of January, the first week of February? And look how many markets do change at the end of January, just on the seasonal basis. So that could be a point. Then we head up again. I don't know. And then one of the strongest ones that we've got with the highest potential returns. We're doing something using seasonality and returns to get the highest probability. So we're combining two things here. This bit here is one of the highest opportunities, and that's from the beginning of May into the 15th of May. So matching this up with the cycles as well, and of course being able to manage the risk is something. But my view is the dollar might go quite a bit higher. And with that in mind, the weakest currency, in my opinion, is the British pound. I don't disagree with Jake. He says he's very, he's reasonably bullish. I'm actually quite bearish on them at the moment. And what we're seeing here, a few points. There are some super macro cycles to do with Britain, which are just kind of outside the scope of today. But what we're seeing here is that we've seen a big drop in people trading this British pound, okay, in the commercial money, that the selling and the buying's dropped off. And also the hedge funds are now getting short on this as well. And we're about to go net short with the hedge funds, but net long maybe with that would be the argument for a bull market once this goes net long, but it needs other factors there. But I do think this here was the, if we get a pullback, by the way, which I think we're due for here, it'll probably be like this pullback here. And this is the area I'm looking at here, slight pullback here. And then I think we're going to match this point down here at $1.05. And that was the Liz Truss low, where we had a prime minister in Britain who I think she lasted 42 days. And they did say that a lettuce was grown that lasted more than she did. So that was the thing. Her policies were just crazy beyond belief, with no real understanding of how the real world works. So the pound dumped, it did rally. I'm wondering if we're going to see something else, because opposite party, not the Conservative Party, but the Labour Party are in, and this guy Keir Starmer is Prime Minister. He's been in just over 6 months now, and he's absolutely devastated the British economy. So I think there are some fundamental ideas there, but this is just my view, and hence the disclaimer, and things ain't looking that rosy in my opinion. So I think this is the weakest currency. And what do we see here? We might see a pullback. Guess when? Last few days of January. And then I think we could well head down. And that is why I am looking here at around about the third week of March, potentially. We'll fine tune this. Why do we always look at the third week of March? Come on, you cycles people, because that is the equinox point and the beginning of the year, the beginning of the season. So I'm looking here for a double low here, and that is based on this idea here. I don't know if we're going to get as low as 105. It'll be a bit of a problem for Britain if it is. Having said that, all you Americans come and visit us. It'll be cheap as chips. Okay. So strongest currency. Now I'll put this in inverted commas. New Zealand dollar. Look at this here. Got the highest levels ever in terms of positioning of the commercials. And look at that, way net long. And the selling has come off. And look at where the hedge funds are. They are selling it like crazy. That is the highest level of selling. Now, remember, the hedge funds are always wrong at extremes. If you understand commitment of traders data, I use it slightly. I use exactly what Jake does, but I also do this slightly differently. I look at the relative positions, and you can see how these things here. Look at that huge gap there. So I think we're coming to a triple low. Now, ordinarily, this could be in for a big bounce, but the New Zealand dollar cannot take on the US dollar by itself. So that is really important. So I think we're coming down to a triple low. We might go a bit lower, and then I think we're going to see a bounce. I think that's quite instrumental with what is going on. So that's that one. What else? Bitcoin. Right. So Bitcoin, somebody asked this in the questions earlier. Right. There is an inverse correlation here at the moment going on. And what we're seeing here is that we tend to see lows where we get extremes here of commercial buying. And when we saw that low, we saw this. Sorry, this high here in commercial selling. Let me just catch my own breath here. This red here is a very high level of commercial selling, brings a low in. High level commercial selling, and we've got this move up here. And we're back up to here. And the selling is high, the buying is coming off, and also seeing the highest level of exposure. And it's exactly what Jake said. All these, the commercial side here is all about setting up funds. And all the big players are in on this now. So, Bitcoin isn't going away. But it works. So I think we are possibly on the verge of a new move up. Not convinced yet, because I think if we get a geopolitical move on the markets, Bitcoin is going to be impacted with margin calls. I think this is where the money is now. That's why it's less in gold than what it used to be because it's in crypto. If we start getting a crashing market, I'm not saying we are going to get one, but if we did get one, I think the money's going to come out of here and it's going to pull this one back. And basically, what did we see? The last move up there, the last pullback. In fact, two things. I've got the wrong slide. Well, actually, we've got the right slide on the wrong slide. The move from here to here was exactly the same as the move from here to here, a measured move. So I wanted to see this come down $24,500 to this point here. It hasn't done so far, but that would be a beautiful place to buy it. And if it does, then we would go up this much. And in Elliott terms, 1, 2, 3, 4, 5 would take us, what's that taking us up there? 75 down there from 20. So 55 up from there, I think would take us 85, 90, 140,000. So 144,000 if you're into GAN. So that would be a suitable major top. We might see that. Jake's cycles are interesting. I don't have any strong views, at least not right at this moment, for the event on when this might turn. So it hasn't pulled back this full 0.382. It's been moving up today. If it doesn't get back to here, what does it tell us? It tells us that pullback there is less than this, and therefore it is more bullish. Time will tell. So that's it. I'm happy to take some questions. Just a quick shout out. We've got YouTube channels both at the foundation, and come and have a look at ours at the Market Timing Report. I'm on LinkedIn and Twitter, and you can get hold of me through this site here, markettimingreport.com. Now, let's take some questions. More than happy to do that.
Thank you very much, Andy. Plenty of key insights for our audience to reflect on. The Q&A box has been buzzing throughout your presentation, which is a great thing. With lots of thoughtful questions, many market outlook questions in terms of your views, but also a few technical questions on cycle applications. So I'll mix and match in the time that we have left.
Okay.
And I'll do my very best to pick the best of the bunch, and then I can send you the rest if we run out of time.
Sure.
Okay, so the first one is your opening comment on the decennial pattern. bar none, this has been a top question to the FSC in 2025 in the last few months, for the obvious point that it's on top of mind. Now, most of us integrate it within our work in terms of FSC leadership and many of the audience members. Most are looking as for 2025 as being the sweet spot in that pattern for outperformance. But you highlighted a nuanced point that it's not a linear trend up for the year of 2025. So could you recap and expand on that point?
So the point really is that the market never, I say never, it does very occasionally replicate exactly in certain markets. What I'm thinking is that the evidence suggests that we will close higher this year. Okay. But there are other cycles that come from the DNA of the market itself that suggest that we are going to see some sort of pullback. Okay. There are other turning points that I think are going to see a pullback. And time is one of the most important things. So, we're seeing a 30-year cycle come in. Okay. Now, a 30-year cycle will trump a 10-year cycle. Okay. It just will, because we know the 30-year cycle is very important. Just like a 60 and a 90-year cycle will override these things. It's all well and good going surfing in a moderate surf, but if a tsunami comes in, you're gonna know about it. So that's the whole point, is that none of us know what's going to happen, but we're trying to make educated guesses based on getting the odds on our side. And that's what it's all about. So does that answer your question? The thing is, the 30-year cycle coming in from the beginning of that 95 bull run. And then, we are just, 15 years off that 2009 low there, So, yeah, arguably it's 9 months out. There's a degree of cycle translation. So, and it's that cycle translation that's going to move things backwards and forwards. But it's not just the translation of the cycle, it's the sub-cycles within it, which are not necessarily static. There's a lot of dynamic stuff there and static stuff in there as well. So that's just my view, but I could be talking rubbish. It wouldn't be the first time, Ron. You know that when we've drunk some red wine on several occasions when you've been here. So
we're all living and learning, and we're all watching the cycles in action. And the great points that I'm taking from what you've just shared, and the audience too, is that there are cycles within cycles, that there's no standalone out there. And so certainly we're all looking at different types of cycles and applying different techniques. And that's what you've demonstrated yet again today. And likely for that reason, you have a nuanced cycle view for the year ahead. Point number one, in terms of the cycles within cycles, but also you made an interesting point on market context. How do these cycles play out in a strong or weak, bull or bear market cycles? Of course, that will have an impact. And then I thought the interesting final point you made on that is that these are patterns that rhyme but not necessarily repeat each time. And you've made that point, I think, now, but also in the past a few times.
Yeah, absolutely. That's one of my mantras for sure. Yeah.
Great. And then we have a follow-up question, also a popular question, I think, for some time, on the Benner cycle. You mentioned right at the back there of the presentation. I noted down your observations of lows every 11, 7, and 9 years, highs every 8, 9, and 10. And of course, the big bottom line expectation is for an inflection point in 2026, and then the correlation with the 18.6-year cycle. So just recapping for those of you that were watching and want to note down again, this is probably a good framing for the first question on the 18.6-year cycle and how you positioned it with the Benner cycle. From one of our participants saying, is there a divergence of opinion on the 18.6 year as an economic cycle versus a stock market cycle? And he alludes to our FSC Science Director, Ray Tomes, that said that Dewey once said fair, as in kind of like a cup of the whim sound. 18.6 year cycle, sometimes deviates according to what you're using.
Yeah, so here's my views on this, right? The stock market cycle and the economic cycle are not always in sync. That's just the way it is. From my viewpoint, I'm just going to add this in now. I look at super macro cycles, and the 18.6 year cycle, steady as clockwork. Our leader, Edward Dewey, documented it in so many things. And, it's in all the books, it's in the cycles book there behind and everything. But I tend to look at super macro cycles. And what we will see is the 100-year cycle will come in from the 1929 crash in 2029. Now, for those of you who've been following the work that I put out there, you can see how stock market cycles repeat. The 2007 global financial crisis I wrote about 2-3 years in advance because it was 100 years on from the rich man's panic. It was going to be 100 years on. It was forecast. It was 200 years on from the 1807 Embargo Act that crashed the US stock market in the Napoleonic Wars by nearly 90%. So we knew something big was coming because that was also verified by the midpoints. 1857, the Cincinnati, the Ohio Life Trust in Cincinnati failed. That was one of the big railroad boom and busts. So we knew that harmonic, the 50% harmonic was in there. 1957, the secular bull market. So secular bear market, because everybody that could own a fridge had one, a refrigerator. Everybody wanted an automobile and could afford one, had one. Everybody wanted a television, could afford and had one. So there was a pullback in manufacturing. So 1857, 1807, 1857, 1907, 1957, 2057 next, 2007. This 100-year cycle works. Therefore, 1929 plus 100 years is potentially a serious point there, okay, as a significant high in the stock market. And what that means is the stock market, in my opinion, could carry on up. Okay, I mean, there might be severe pullbacks. Years ending in 7 often see pullbacks, apart from 2017. So there could be things going on there. Yet the economic environment could well slow down by 2026, 27. So does that answer? That's just one cycle. And of course, whilst we're on this business of 2029, remember that's going to be the 90-year cycle from the outbreak of the Second World War. So things ain't looking pretty as we go to the end of this decade, I'm afraid. But for those of us who've been around, we've actually had 20, 30 very nice years in the Western world. So this is cycles, isn't it? And as the good book and every other text says, there is no new thing under the sun. Human behavior repeats. Sorry, you're going to get me on a rant there, Ron. Let's do the next question.
All good. You actually hit on the grand finale questions.
I haven't even seen them yet. I didn't look around, right?
On that heavy subject that we don't like to talk about, but it's clearly in the air, geopolitical tensions, which have been with us for some time. You refer to it as proxy wars, which may lead into a bigger war. It's more of a technical question. Well, technical and macro. Technical question: when you're choosing your war points in order to anchor the war cycle, there's often a question, which I'm sure you've been asked many times before, on selection, which wars to choose and which not. And it's maybe there's a whole paper just on this one question, which has written or can be written. But what's your brief insight on best practice?
Right, this is a really good question. Now, we did cover this. It's on the one of the early foundation videos on the YouTube channel. Right, so you have to put things in context. And I see, is it John Buchan here? Why does your World War II, why do you use World War II, not World War One? Yeah, right. So that's a great question.
Exactly the question, and there were variations of that question.
Right, because it's not one timeline; it's several timelines. So how do I do this without giving the game away? I don't mind if I give the game. This is why I can't attend tomorrow, because I'm with some people from agencies, government agencies. I want to talk about this stuff, and it's going to be a night away. So this is what you do: is you put things in context. So if you want to look at a timeline between two countries, you can only work with the wars for those two countries and the events. That's how you find the key points. If you start mixing them all up, you're not, it's like if you put too many different colored paints into a thing, it always ends up brown. I don't know why it does, but it just always does. I said. So the point is that you can spill cycles out from the First World War, and you can spill cycles out from the Second World War. But in fact, they go back further back in time. Okay. So they do all work, but you've got to lay them out on different timelines. And the truth is that whilst Germany and Europe were engaged in both wars, okay, and Britain, they're actually part of different patterns. So you have to strip them down. So this is the same way as we look at this idea of a short-term cycle, a long-term cycle, a medium-term cycle, and where they all come together is when an event occurs. But they're on different timelines. Okay, so it's a great question, John, wasn't it? Yeah, and if you want to do the work, we've done some work on this actually. You'll see it will fit into a different set of war cycles. But the key point is that there are unfortunately these events that and that bring in several countries rather than just two nations in conflict. And I refer this back to the Crimean War, and basically it's the superpowers of the time that get involved in these world wars in inverted commas. Crimean War. Then we had before that we could argue that the Revolutionary War, because Britain and America was becoming was on its journey to become a superpower. Britain was perhaps the superpower of that time. Well, not perhaps, it was, along with other maritime nations such as the Netherlands and so on. But so these have to be put into context, and that's the answer. Yes, they all work, but if you try and relate First World War to the Second World War, there is some sort of confluence, but they're actually different cycles.
We're getting lots of positive feedback on what you just shared there, as you can probably see in the chat.
Let me have a look. Right.
Hope is saying, loved your presentation. You speak cycles, amazing perspective. Soho is saying, can we feed all wars into the cycles app? We can maybe follow up with Lars on that one. Maybe challenging, but there's lots of past research in this. So do look at the FSC cycle archive. And actually, if I can ask you actually, let me also spotlight David's comment. Every seventh iteration of a 12th-year cycle, which is a fractal of both 84 and 144-year cycle since 1776. So there's some very interesting research insights being shared there. If I can close with a question on Trump economics, which you did mention. My presentation tomorrow will be on Trump 2.0 melt up or cycle peak. So we're all on point with what's happening next week, the US inauguration. The question is actually here from Kim, and it was asked a while ago. Do you think that the 18.6-year cycle or other cycles that you're watching is my caveat that I'll add to that, could be extended in a positive Trump policy impact scenario?
Yeah, it could be. Yes, it could.
Melt up. Is that on
Yeah,
your
I
radar?
think it's possible because we could get an inversion. We could get an inversion. Yeah, cycles can invert. That with my cycles work, I find 5 to 6% of cycles will invert. So it's possible. We could get one. I think it's unlikely, but it is possible, and it could be an artificial melt up as well. That could be unsustainable. It could be a cycle translation and elongate things. Personally, the cycle hasn't failed much in the last 200 years. So there's a couple of other questions here actually I'd like to address. Yeah, but has that answered that one?
Yes, absolutely. And feel free if you'd like to pick a question to close, feel free.
There are so many here, aren't they? Issues. Let me run through a few. Are we all right for time? How are we doing for time? Have we got a few more minutes?
We have a few minutes to take a question and to close. Yes.
Right. So I see there's a 16-year-old, which I love young people
a
getting
book
into this.
request. That's a great question, especially for the young audience out there.
In Las Vegas, and I want to know your opinion on a book in addition to your books you could recommend for me. Oh, right. Okay. Well, you 16-year-old young man there. The Secret Wealth Advantage would be the perfect book for you. That is it. I would go for that. That explains all these things, explains real estate. And I tell you what, I love it because we had a masterclass the other week and we had a 17-year-old on that as well, whose folks had treated. I actually knew his parents. And so I love all this. I love the youngsters getting. We need young people in all this. So that's a good one. I wanted to do that. Issues with the Falklands. Yes, as this is going to be big. The briefing, well, I shouldn't say any more on that. But if you take the 82 to 84 year cycle, halve it, you get 41 years. If we go to 1982, 83, add 41, 42 years. That was the half pattern. But remember, half the 90-year cycle is 45 years. So if we take 82, 2027 is going to be the year that I think we're going to see problems. So Britain is going to see problems with Argentina. And So that's that one. What else? Somebody's put that's that. Books suggesting stock market peaks 1 to 1.5 years after. Yeah, Wayne, that could well be. I like that one. What else? Have we got all the ones? That this one with David Bernstein is fascinating. The seventh iteration of the 12th cycle. You mentioned that. I think that
Yeah,
is
I
super.
spotlighted that. It was an interesting insight.
Yeah, that I'd like to look into that a bit more myself. Somebody here has questions, but they haven't typed them in. Who's that?
There's a last question there from Kevin on the Kondratiev long wave, which is
Yeah.
inflation related, but also social mood and war. Any key and brief insights in the time that we have remaining on that? It's a great question.
Great question. The K wave is definitely there. Now, come to New York. Whoever said that? Kevin Hogan. I don't know where you are. Come to New York.
That's a great teaser for New York.
Right. So, well, I'm really looking forward to it because A, I love New York, right? But B, it's going to be great to meet so many of you. Now, let's think about this. What is 3 times 18? I think it's 54, right? Now, what is 3 times 18.6 or 18 and a half is going to be 55, yeah? 55 and a half. So what are we seeing here? That is, in my opinion, the K wave. That is the 18 to 18.6 year cycle times 3, okay? And also 55 is a Fibonacci number, right? So if you're looking at 55-year cycles and so on, that's quite interesting. So the question was, what was the question? What is your view of the
General
value of
overview
it?
on the K wave.
Yeah. Yeah. So
Yeah.
it certainly exists. I mean, Kondratiev's books, they're all sitting over there. Just you can't see it. I mean, you can't remind you this, but well, you know, you've been here, Ron. You know how many
People
books are
will
in
be
this room.
zooming in at home on their
Yeah,
computer
yeah, yeah.
screens.
Kondratiev's works over there. It's a shame he got sent off to Siberia and executed or whatever. But yeah, it works. And it's actually more to do, in my opinion, with 3 times the 18.6 year cycle.